Enron built companies whose only job was to absorb its losses. Then it backed those companies with Enron's own stock. Look at what that means. The thing ensuring Enron against collapse was Enron itself. A hedge backed by the very thing it was hedging, which only works as long as the stock never falls. Now hold on to that, because for 6 years running, the smartest people in finance voted this company the most innovative in America. They were right. They just never understood what it was innovating. In the fall of 2001, the seventh largest company in America went from $90 a share to 26 cents in under 2 months. $74 billion gone. Thousands of people lost their jobs and their savings overnight. It wasn't an accident, and it was barely even hidden. Enron didn't collapse because a bet went wrong. It collapsed because it bet everything on itself. To understand how, you have to go back to the beginning. Start with the boring truth. Enron was a pipeline company. Natural gas, pumps, contracts, Texas. The least exciting business on earth. Then, a former McKinsey consultant named Jeff Skilling walked in with an idea that would make all of it disappear. Skilling didn't want to own pipes. Owning things was for losers. He wanted to own the trades. Enron would sit in the middle of every energy deal in America, like a bank sits between you and your money, and skim the spread. It worked. By 2000, Enron reported $100 billion in revenue, and the market couldn't buy the stock fast enough. But to make the story perfect, Skilling needed one more thing. He needed to change what the word profit meant. In 1992, regulators let Enron use something called mark-to-market accounting. Remember that name. It's the first gear of the machine. On paper, Enron was a rocket. 6 magazine covers. The smartest guys in any room. Underneath it, the rocket had no engine, and a small number of people knew. So how do you build a machine like that? It runs on 3 gears. The first pulls tomorrow's money into today. The next 2 shove today's debt into a room nobody's allowed to see. Gear 1, mark to market. Normally, you book a profit when the cash actually shows up. Mark to market lets you book it the day you sign. Sign a 20-year deal, and you can report 20 years of imaginary profit right now. All of it. Today. Enron signed a deal with Blockbuster to stream movies. They booked the profits immediately. The service never worked. The deal earned essentially nothing. The profit had already been counted, which creates a trap. Once you've spent a deal's entire future, you need a bigger deal next quarter just to stand still. So the profits were real on paper and fake in the bank. That gap had to go somewhere. Gear 2, the back rooms. The rule was simple. If an outside investor put up just 3% of a side company, its debts weren't Enron's problem on paper. Enron used that 2 ways: hide the debt and sell its losers to itself for a fake profit. The first backroom was called Chewco, named, I'm not kidding, after Chewbacca. Chewco bought out Enron's last real outside partner for $383 million. Except they couldn't find a real 3% investor, so they faked it with a loan Enron itself guaranteed. When that was finally discovered, it forced years of hidden debt back onto the books. Over $700 million in a single year. The second backroom was run by Enron's own chief financial officer, Andrew Fastow. He called it LJM2, raised $394 million, and sat on both sides of the table, Enron's and the buyers. The man negotiating for Enron was also the man getting rich off the other side. The board waved it through. But hiding a loss doesn't make it disappear. The losers just piled up in the shadows, rotting, waiting. And there were billions of them. If you're following this far, you already understand more about Enron than most of Wall Street did in 2001. Subscribe. The last gear is the one that killed them. Gear 3. The Raptors. 4 shell companies, named after the velociraptors in Jurassic Park, built to swallow Enron's losses so they'd never hit the books. They hid close to $1 billion in losses. In the second half of 2000, more than 80% of Enron's pre-tax profit came out of these 4 boxes. Now, Ask the only question that matters. What were the Raptors using to absorb all that loss? Collateral. And their collateral was Enron's own stock. Remember the loop from the very start of this video? This is it. The thing insuring Enron against disaster was Enron itself, which means the hedge only runs one direction. The day the stock dips, the insurance dies with it, at the exact moment Enron needs it most. And that's the whole trick. Belief held up the stock held up the back rooms manufactured the profits that kept people believing. A perfect circle with absolutely nothing in the center, which means the entire machine had one fatal instruction: never let the stock fall. In August 2001, Jeff Skilling, the architect, the true believer, abruptly quit. Personal reasons. 4 months before the end. The day after, an executive named Sherron Watkins wrote the CEO a memo. Her words: "I am incredibly nervous that we will implode in a wave of accounting scandals." She was right to the month. On October 16th, Enron reported a $618 million loss and quietly erased $1.2 billion of shareholder equity. The Raptors unwinding. That's the first domino. The machine had exactly one rule: never let the stock fall. This is the moment it falls. The SEC opens an investigation, and once people start actually reading the footnotes, the whole structure reverses. As the stock drops, the Raptors lose their collateral, which was the stock. The insurance fails at the exact moment the claim comes due. Every loss they were hiding floods home at once. Now watch what the people who knew did with the time they had. Enron froze its employees' retirement accounts during the collapse. Locked them out. They could only watch. More than 60% of those savings were in Enron stock. Around 15,000 people lost more than $1 billion. While they were locked out, Ken Lay, the founder, was quietly selling more than $90 million of his own. A rescue from a rival called Dynegy appears, looks at the real books, and walks away within weeks. The credit agencies downgrade Enron to junk. That triggers debts it can't possibly pay. On December 2nd, 2001, Enron filed the largest corporate bankruptcy in American history, $63 billion in assets. Its auditor, Arthur Andersen, one of the 5 biggest accounting firms on the planet, was caught shredding the evidence and died with it. And the hardest part? Every warning was sitting in plain sight. Months earlier, a reporter named Bethany McLean had asked one question in a headline: "Is Enron overpriced?" She'd noticed the simplest thing. Nobody could actually explain how the company made money. The self-dealing was disclosed. It was in the footnotes. Almost no one read them. And the cash? They faked that too. Enron disguised $8.5 billion in bank loans as gas trades, routed through shell companies named Mahonia and Yosemite. No gas ever moved. The borrowed money got booked as cash from operations, alone wearing a costume. Strip that costume off, and the truth was simple. Almost no real cash ever came in the door. The gap was sitting in the cash flow statement the whole time. Here's the lesson they paid $74 billion to teach you. Earnings are an opinion. Cash is a fact. Enron had wonderful opinions, and everyone, the analysts, the auditors, the press, chose to read the opinion. Years later, the man who built the back rooms put it more honestly than anyone. "I knew that what I was doing was misleading, but I didn't think it was illegal." That's not a confession about Enron. That's a description of how it always starts. The machine didn't need villains twirling mustaches. It needed smart people, one reasonable-sounding step at a time, until the only thing holding it up was everyone agreeing not to look. Enron was the biggest. It was not the last. Because the next one is never built by people who think they're committing a crime. It's built by people who think they've found a loophole.